as corporations offer business owners a unique combination of liability protection and tax advantages. But before you elect this business structure, there are critical factors you need to understand. An S corporation is a special tax designation that provides the liability shield of a corporation while being taxed as a pass-through entity. This means profits and losses flow directly to shareholders' personal tax returns, avoiding the double taxation that affects traditional C corporations. To qualify as an S Corp, your business must meet specific IRS requirements. You can have no more than 100 shareholders, all of whom must be United States citizens or residents. Additionally, only certain types of entities can be shareholders, excluding non-resident aliens, other corporations, and most trusts. When it comes to liability protection, S Corp functions similarly to traditional corporations. Shareholders are generally not personally responsible for business debts or legal actions against the company. This means your personal assets like your home, car, and savings accounts remain protected if the business faces financial difficulties or lawsuits. However, this liability shield has important limitations. If you were originally operating as a sole proprietorship or partnership before incorporating, your personal assets could still be at risk for obligations that existed before the S Corp election. Additionally, if you use personal assets as collateral for business loans, those specific assets remain vulnerable. The liability protection also doesn't shield you from your own actions. If you personally cause damages or act fraudulently, you can still be held liable. Similarly, the corporation itself can be held responsible for employee actions if those actions were authorized or related to normal job duties. One significant tax advantage of S Corp is the potential savings on self-employment taxes. In an S Corp structure, only the reasonable salary paid to owner employees is subject to payroll taxes. Additional profits taken as distributions are not subject to these taxes. However, the IRS requires that owner employees receive reasonable compensation before taking distributions. S Corp differ from other business structures in several key ways. Unlike C corporations, S Corp avoid double taxation but have ownership restrictions. Compared to limited liability companies, S Corp require more corporate formalities, including regular board meetings and maintaining corporate records, but may offer greater self-employment tax savings. Compliance is crucial for maintaining S Corp status. You must file Form 1120S annually, issue K-1 forms to shareholders, maintain corporate formalities, and ensure owners take reasonable salaries. Some states don't recognize S Corp status or impose additional taxes and requirements, such as California's annual franchise tax. Failing to comply with these requirements can result in the loss of S Corp status, causing your business to default to C corporation taxation, with its double taxation consequences. S Corp are particularly beneficial for businesses with low startup costs, minimal equipment needs, and the potential for significant profits. Service-based businesses often find this structure advantageous due to the self-employment tax savings. Before electing S Corp status, carefully evaluate whether your business can meet the ongoing compliance requirements and whether the tax benefits outweigh the administrative burdens. Consider consulting with a qualified business attorney or tax professional to determine if an S corporation is the right choice for your specific situation.